Saturday, January 15th, 2022, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at the Potemkin economy and specifically at the UK example before we go into what Potemkin means and how it relates to the economy. Just wanted to say that yesterday I did the usual Friday Mike and Mario show. It's live on Mike's channel, Rethinking the Dollar, at 5 p.m. London time. And usually I post a copy of the Mike and Mario show on Saturday morning on my channel. You might not have seen it pop up today, and that's because I published it last night. So yes, the Mike and Mario show was on, and it is on my channel. And if you'd like to, you can watch it later on or tomorrow or whenever you want. So Potemkin, where does that term come from? Well, let's go through Wikipedia, what they say about the Potemkin village, because that's where the term derives from. And it says, in politics and economics, a Potemkin village is any construction, literal or figurative, whose sole purpose is to provide an external facade to a country that is faring poorly, making people believe that the country is faring better. The term comes from stories of a fake portable village built by Grigory Potemkin, former lover of Empress Catherine II, solely to impress the Empress during her journey to Crimea in 1787. So you see, the Russians, they have been in Crimea for a long time, over 200 years. They didn't invade Crimea. Anyway, that's a different subject. Let's continue with the definition and the story. While modern historians agree that accounts of this portable village are exaggerated, the original story was that Potemkin erected phony portable settlements along the banks of the Dnieper River in order to impress the Russian Empress. The structures would be disassembled after she passed and reassembled farther along her route to be viewed again as if another example. So it was quite a deceptive thing, you have to admit. But that's a Potemkin village. That's where it comes from. So why the UK Potemkin economy? Well, yesterday we had some GDP data for the UK economy, and all the major news outlets are reporting it as if the economy is back to normal, that we are to pre-pandemic levels. We've gone back to pre-pandemic levels, that things are going well for the economy. But I like to dig deeper and try to show you that it's anything but, that it's just a facade. And what's the reason for me doing that? Is that, am I trying to spoil a party? No, I'm just trying to inform those who want to listen to me that things might not be as good as they are, and this might help you. It depends, of course, in what position you are. If you are a student, if you are an employee of a big business, if you have your own business, it might help you planning for the future. It might help you in your behavior towards investing or spending. That's what I'm trying to do here. I'm trying to put more of a realistic picture on things, because as we know, there are lies, damned lies, and then there are statistics. So it's very easy for governments, politicians, and bankers, and the mainstream financial press, and also the mainstream press that is behind this, right? The establishment. We've seen, of course, with the pandemic, that the mainstream media is very difficult to trust. They've been scaring people, of course, publishing all the data every day about the pandemic, basically trying to scare people. And here we got the opposite. They're trying to like make people think everything's fine. So before I look at a couple of articles here, one from the FT that talks a little bit about the economy, and the other one from the FT talking about how UK homes or the UK consumer could be hit really hard, even harder than people previously thought, from the energy crisis. So we're going to look at how GDP is calculated. GDP, of course, means gross domestic product. So the equation for GDP is consumption, and that can be private consumption, business consumption, all kinds of consumption in the private sector, plus investment. Again, private investment. It can be on an individual basis, a corporate basis, or even NGO basis, anything that's non-governmental. And then you got plus G, which is plus government spending, and then plus net exports. So they add that up and you get GDP, and usually GDP is published in terms of growth, how much it's growing from the previous quarter on an annualized basis. And they've changed the way they report GDP ever since the lockdown started in 2020, mainly because I think they're trying to just show the numbers that are growing like on a month-on-month basis. It used to be quarter-on-quarter basis, but that makes it look a little less stable. But anyway, we need to look at how government spends money. And we know that governments don't create wealth. Governments tax. They tax the private sector. So this equation, this way of calculating the gross domestic product, I would say is not really, it's a Keynesian way of doing it. They basically saying that they'll take wealth from you and add it on to the national pie and count it again. So it's like a double counting, I would say, to add government spending to GDP. And I guess when governments are running like a balanced book, which is, I don't remember the last time the UK ran a balanced budget or even a budget surplus. It has to be way before the '08 crisis. So it's been almost 15 years. The UK has been running budget deficits. And the thing is, the bigger the budget deficit, it means the bigger the government spending is, and the more it distorts GDP, the more it makes GDP look good. So if we go back to 2020, when we had the lockdown, and also 2021, we had a lockdown up until March, from like just before Christmas 2020 to March. So in 2020, the budget deficit was 14.9% of GDP. Just to give you an idea, during the '08 crisis, I think the budget deficit got to like 10%, and then it decreased over the years. I remember George Osborne, who was the Chancellor of the Exchequer in 2010, saying he wanted to balance the budget by 2015. But even in 2019, prior to the pandemic, the budget deficit was around 2.5%, maybe 3% of GDP. So as you see, they haven't been running a balance or a surplus. So what this means is that the government borrow basically 15% equivalent of normal GDP to spend. So you can see how that GDP number got distorted. If they hadn't had such a big budget deficit, the GDP numbers for 2020 would have been even worse. I think it was the worst recession in 300 years. I think the UK economy shrunk by like 10%. And then in 2021, you would have thought with things coming back that the governments would not spend as much, but the budget deficit for 2021 was 11.7%, so almost 12%. Again, making it look very distorted, the GDP. So we got this GDP data yesterday, and it was, I think, for November 2021. So you can see how distorted it is, that it's the government making the numbers look better because they're borrowing from the future and they're spending it. What are they spending it on? Well, I don't know exactly, but I would say a lot of it is to do tests and to buy stuff, medical stuff, right? That's how our economy has been led into. It's been led into that kind of economy. It's not an economy that's healthy, I would say, and I'm going to come to that in a minute. So for the tax year ending in 2022, or for the whole of 2022, the budget deficit expected now this year to decrease to 4.7%, still almost around 5%. And I would bet that number is going to be worse than expected. It's probably going to be somewhere like 6 or 7. But as you can see then, by the equation, GDP equals C plus I plus G plus net exports. You can see why when governments are running huge deficits, it distorts that GDP number. The other thing I would say is that a healthy economy is an economy where people are working, where there is a sound currency, where there's no inflation, and where people can save some of their surplus earnings and then maybe think about investing those earnings. And of course, for people to save, there has to be some incentive. Usually that's the rate of interest that you can lend your savings at. And you might put that in the bank, or you might lend it, buy a bond or something. But as we know, since the '08 crisis, basically the base rate, or the rate that banks give you for a deposit, is basically being near zero, maybe a 0.1 or 0.05. So there's no point in savings. And that's why we're seeing a lot of speculation, and that's why we're seeing a lot of borrowing and spending, but there's no savings or investments. And who's to blame? Well, I would say it's the government and the central bank with their fiscal and monetary policy. And the governments, of course, have been helped out by the central banks. Central banks are manipulating interest rates by creating reserves out of thin air. That's what QE is, buying bonds to drive down their yields or interest rates. So you've got a situation, and this is creating more and more rising prices, which is hurting the average person who basically, whose standard of living is going down. They need more and more of their earnings to pay for necessities, and they have very little left to try to save or invest. And the only kind of investments there are, of course, are very risky, very volatile, but there's no, for example, safe investments, so to speak, like investors had in the 19th century when money was very sound. You could put some of your savings in government bonds at maybe 3.5%, 4%, let's say. But nowadays, we've seen that the latest figures for RPI, or the figures that are going to come out next week. For example, RPI, which is the retail price index, that's the measure of inflation that this country used to use before they came along with the CPI, which is usually 1% lower than the RPI. So on Wednesday, the RPI is expected to come out at 7.2%. So our currency and our standard of living is being debased by 7.2% a year. And if you look at interest rates, for example, the 10-year government yield, or the gilt yield, UK government bond, is 1.15. So savers are getting completely annihilated. 7.2 and 1.15, that's like, minus 6%. So you're losing a lot of purchasing power by keeping your savings in the bank. You can't save anything. And if you can't save, you can't build a nest egg to make investments. And you could say the CPI is lower, but it's still 5.2%. And here, as you can see, it's 2% lower. Usually it's 1% lower. They're going to focus, of course, on CPI, but I would say the RPI is the one to watch. So how can we have an economy that's doing well and is back to normal, so to speak, when you have this kind of environment? Well, it can't. And that's why I think it's a Potemkin village. So the article here in the FT says, UK economy grew beyond pre-pandemic size before Omicron hit. So they're trying to blame now Omicron for the fact that the economy isn't really doing well. It says GDP growth in November beats estimates as all sectors expand strongly. And the most interesting comment, and I'm not going to go through the whole article, I'll put a link to it in the description. And if you don't pay for the FT, if you don't have a subscription, use a browser or a website called archive.ph, and then take the link that I put in the description and put it in the little red box on that website, and it will process it and give you a free version of the article. But it says here, Grant Fitzner, ONS chief economist. So that's the Office of National Statistics. They have a chief economist. I don't know why. They're just supposed to be crunching the numbers and publishing it. Why would they need an economist, right? And it's a government institution. It's like the BLS in the US. So this is what he said. The economy grew strongly in the month before Omicron struck. And this is the funny part. And no disrespect to these people, but how can an economy really flourish and grow? And he says, with architects, retailers, couriers, and accountants having a bumper month. So nothing about manufacturing or production, right? But unfortunately, the UK economy has gone too far into just services. It's this modern thinking, Keynesian thinking, that you can have an economy that doesn't produce anything tangible. 80% of our economy is services. But anyway, and then you have another article in the FT that came out yesterday as well, talking about UK homes face fresh energy pain with price cap set to hit £2,400 this year. Latest analysis for the FT predicts second sharp rise in electricity and gas bills by next winter. Another reason why I don't think the economy is doing as well as they're trying to portray. Yes, they're saying Omicron is going to slow things down, but I think it's more than just Omicron. It's the cost of living going up. It's the consequence of years of inflation, years of negative real interest rates, years where people have just been borrowing and spending and not saving and investing. And And honestly, I couldn't blame them because there's no incentive to save. And the reason for that is that we've built up a huge credit bubble, an economy that's dependent on borrowing, cheap credit and spending, and no investment and production, right? But another little clip from this article, again, I'm going to put the link below in the description, and you can use the same website to get a free version. It says here, the EN app SYS analysis tallies with estimates of some energy suppliers shared privately with the FT. One senior industry source said that based on current forward energy prices, the cap next winter could reach £2,600. So in the headline, they've put £2,400, but in reality, it could be even more. It could be 2,600, or who knows, it could be 3,000. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great weekend. Take care. Bye.